gentlemen, good day and welcome to the conference call for discussion of financial results of second quarter and half year ended on 30th September 2025 by the Anup Engineering Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Before we proceed to the call, let me remind you that the discussion may contain certain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our businesses that could cause actual results, performance, or achievements to differ significantly from what has been expressed or implied in such forward-looking statements. Please note that the company have uploaded the results, press release, investor presentation, and also the outcome of the board meetings on the website of stock exchanges and website of the company. I now hand the conference over to Mr. Reginaldo D'Souza, Managing Director and CEO of the company. Thank you, and over to you, sir.
Thank you. Hello everyone, and a very warm welcome to this conference call on our Quarter 2 and H1 performance for this financial year, period ending 30th September 2025. Carrying forward on our Quarter 1 performance, I believe we've had a fairly good performance in Quarter 2 and H1. At the end of H1, the consolidated revenue achieved is 407.5 crores, a 20.2% growth, with an EBITDA of 91.8 crores, a growth of 20.3%, and with a 14.3% profit after tax of 58.3 crores, a growth of 3.1%. The export revenue was as planned at 56%. I am pleased to state that all our three manufacturing locations are contributing well to the revenue growth. The Ahmedabad plant contributed 256 crores, that's 63% to the revenue. Khera plant at 143 crores, that's 35%, and Naval Engineers with 8 crores, that's 2%. Naval Engineers is seemingly low on revenue, but please note it is in line with the project execution plan as most deliverables are in Quarter 3 and Quarter 4. Therefore, we will see substantial uptick in revenue for Naval in the coming 2 quarters. These revenue contributions from all three locations provides the confidence and re-emphasizes that our investments were timed right and are now delivering results. The sectoral revenue across industries was also as expected, with oil and gas at 42%, petrochemicals at 30%, and fertilizer and chemicals at 18%, with 10% coming from others. In terms of product mix, heat exchangers, which are predominantly manufactured in Ahmedabad plant, was at 58%, and the vessels reactors column, largely manufactured at our Khera plant, was at 38%, and 4% were from silos and other products. Broadly, the sectorial and the product mix revenue are in line with our expectations. The new order booking for Quarter 2 has improved to 257 crores YTD as compared to 65 crores in Quarter 1. Though it could have been better had all the opportunities reached conclusion as per expected timelines. Finalization of many good opportunities, including high-value tenders, were pushed back a little and is expected to be closed by December this year, hence providing good possibilities in this Quarter 3. We have for 600 crore opportunities quoted and expected to be finalized by December this year. The current pending order book is at 568 crores, which implies that necessary orders for the growth guidance of this financial year FY'26 has been fulfilled, and we are now booking orders to be executed only in the next financial year, that is FY'27. The working capital block was a touch high at an average 3 turns, that's 120 days, mainly on account of two factors. One, lower customer advances, and second, higher debtors owing to long cycle time orders under execution, and major being exports with FOB contracts. The duration of collection has been a bit longer as it depends on the availability of ships at the port, which is in our customer's scope. Incidentally, these equipments, being very large in size, has taken a little more time. For your information, as we speak, we have about 150 crores worth of equipment either in inland transit to the port or site or waiting at the port for the ship. But the good part is that most of it will be closed in the next 4 to 6 weeks. Hence, this working capital position is set to improve in coming quarters with improved new order booking in Q3 and Q4, thereby improving customer advances and closure of high value purchase orders in Q3. The working capital is expected to be back at our historical expected average turns of 3.5 plus. The return on capital employed ROCE is about 22.8%. Happy to state that all our 3 manufacturing locations, that is Ahmedabad, Cheddar and Maple Engineers, has shaped up well in terms of requisite capacities and capabilities and are ready to generate about 1,200 crore revenue. The construction work of phase 2 expansion at Cheddar is coming to an end now, of which one manufacturing bay has already been commissioned and the other one is expected before December this year. With this, we would have increased our overall manufacturing capacity in Gujarat from 8,000 metric tons per annum to about 20,000 metric tons per year, an increase of 2.5 times in 3 years. With good CapEx already in place, the focus now would be to utilize and maximize revenue generation from these facilities. This would surely support our future revenue growth plans. On our strategy to get more deeper and wider into the market, we've had a few good developments. Our anticipated presence in Middle East region is now a reality. We now have our official presence in Dubai with a sales and marketing head, MEA region, stationed full time there. This will ensure more aggressive push into the growing Middle East market. And as I mentioned in my earlier call, we would pursue having an official presence in Houston, US too. On our push towards power sector, we have made inroads and won our first direct order after many years from a customer in Europe and is under execution now. So this marks our foray back into the power sector. This will surely pave way for many more business from this customer in future. We have also received our first ever order for a product other than process equipment. This was our strategic intent to diversify. This is nothing but a critical power turbine component which involves fabrication and critical machining for a reputed European players in power sector. This will surely help diversify we made good, interesting progress. We have booked our third order under Anup Technical Services, and as articulated earlier, we plan to execute small technical services and repairs business to help develop our capabilities to play a larger role in the future, which is part of our strategic intent. On our sustainability initiatives, happy to state that we have successfully commissioned our rooftop solar facility at Kheda. So now, with both our locations in Gujarat being rooftop solar powered and with a windmill, major portion of our electric power we use for manufacturing is sourced from renewables, thus helping lower our carbon footprint and also helping us save costs in the longer run and stay competitive. On the broader business outlook, we surely see a good traction in the coming months. We see a strong inquiry inflow from Middle East and also the domestic Indian market. The domestic market has picked up really well with projects like the Bina Refinery, Petronet LNG, Reliance PTA, BPCL Kochi PP plant, and a couple of other petrochemical plants providing good business opportunities. Thermal power plants are back strongly with 3 major projects kick-started and expected to get into capex ordering mode soon. There are also opportunities available in the nuclear power sector through the project being executed by an EPC company in south of India for Nuclear Power Corporation of India. In all, the firm inquiry pipeline with us for global projects stands at approximately 1100 crores. All going well, these should fuel our plan for the next financial year. Hence, at the backing of a robust inquiry pipeline and customers moving ahead with projects, especially in domestic and Middle East markets, there will be good business opportunities in the near future. So considering overall macro factors, we continue to maintain our guidance for this financial year. I would like to state that we are also watchful of all the geopolitical developments globally and are mindful of the risks and challenges that can come our way. We are working on strategic levers and prepared to de-risk any business impact due to these developments. On the strategic initiatives long term towards sustaining growth, we have been working over the last few months on diversification and strategic opportunities. As mentioned earlier, we are looking at opportunities in the space of energy-related technologies, specialty chemical sector, package systems, etc. We are in discussions and we will surely keep you all informed of the progress as we get closer. With these opening remarks, I wish to thank you all for a patient listening and now would be happy to answer your questions or any clarifications required. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vivek Patel from Ficom Family Office. Please go ahead.
Very good afternoon. Am I audible?
Yes, sir, you're
please go
audible.
ahead.
Thanks a lot for the opportunity, sir. Please pardon my questions as I'm very new to the company. Firstly, what is the competitive intensity in the heat exchanger segment as a whole? If one were to describe the intensity on the base of, say, for example, the size of it, right? So less than 20 tons, 20 to 100, and 100 plus. And also, does the complexity of the product increases as the size of the product increases? That will be the first question.
Yeah. So considering Anup and the capabilities that we have in place in terms of manufacturing large size equipment, our competitive advantage lies anything above 30 metric tons per equipment. That's the segment that we are largely competitive with. And the second question, whether complexities increases as a size, of course, from the manufacturing perspective, yes. As the tonnages go up, the manufacturing complexities do increase. But I would say that the major complexities come in as the metallurgy or the MOC, material of construction changes. The complexities increase further with reference to higher metallurgies.
So anything in terms of tonnage below 30 metric tons is very highly competitive market. Is that the correct understanding, sir?
That is correct. Because there would be players in the market who can address those with lower capacity plants and lower overheads.
Understood. Thank you for that, sir. Secondly, continuing on the same lines of competitive intensity, could you please expand on the requirements of a company to become empaneled with a large licensor, for example, Engineers India? What are the requirements for a company?
So the basic capability requirements. So any licensor that a company like us would want to get registered in, we will have to make an application with all our credentials, both in terms of design and manufacturing. And then there would be obviously a shop audit conducted by the licensor, and then those credentials are assessed. And if they find suitable, they would take a company on board. So it's largely the design capabilities as per the ASME code requirements or any other certified code requirements. And second, your capability in terms of manufacturing, which will involve especially welding, because welding is the core.
So you believe many players in the market would have this sort of license empaneled by especially someone as large as, for example, Engineers India or Honeywell? Many players will have this. Only a handful.
Very sorry. See, I think we will restrict this call to the results-related questions. I think you can reach out to us for these queries. These are all very basic nature of queries. You can join back the queue, or we can answer your questions offline.
About the result, just had one small bookkeeping question. Can you throw some light on the increased other expenses and interest expenses for this quarter? And were these one-offs, or can we expect the number to continue? Thank you.
Yeah. So on the other expenses side, it's mostly on the marketing expenses side, which is contributed largely by the royalty part, because we are empaneled, as you said, with process licenses, technology licenses, like Lamak heat transfer. So any helix heat exchangers that we make, and we made a large, we have to pay royalty to the licensor. So we had a good amount of helix heat exchangers and M-Buffer technology heat exchangers manufactured, for which the royalty needed to be paid to the licensor, which was not part of the previous year. So when you compare, that looks to be on the higher side. But having said that, the costs are part of our cost built into the estimation, and that's why you'll never see that impact truly on the EBITDA. And that's why you see our EBITDA maintained at that position.
Thanks a lot for your answer. Thank you. All the very best.
Pleasure. Thank you.
Thank you very much. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, I kindly request everyone to limit your questions to 2 per participant. The next question is from the line of Chetan Bora from Abacus Asset Management. Please go ahead.
Yeah. Hi, Reggie. Reggie, wanted to understand our order book which was always, above 850 crores, has gone down to 575-80 crores. What's your view on that, and whether we would be able to see, the order book again going back to about 850 crores, Reggie?
Yeah. Hi, Chetan. Yeah. So you're right. The order booking, as I mentioned in my opening remarks too, could have been better. If you look at the firm inquiry base or the market, you'll find that we are almost at about 1,100 crores kind of an inquiry bank position. So the opportunities in the market stayed. Unfortunately, things which were supposed to get finalized, like there are a lot of tenders that we have quoted, which were supposed to, we were expecting it to close before Diwali holidays, but it didn't. It moved and got postponed to post Diwali. And that's where we are expecting most of these tenders and inquiries on board to be finalized either in the month of November or December. So we are pretty confident of moving back to our order positions. It's a small little delay from the perspective of tenders and large ticket items, and we are very hopeful and confident of coming back on our order book positions.
Great. And the one thing what I noticed in this quarter, there was a stark, difference between the gross margin, which has gone up to close to 54%, sales minus raw material cost, which is like all-time high. And whereas the other expenses has again, jumped up quite sharply. Can you explain the thing which has helped in improving the gross margin, whereas, that has been largely offset because of the increasing other expenses? You told that, because of the royalty thing, but I would first like to understand, why the gross margin has improved sharply, and is there any other cost sitting in the other expenses?
Yeah. So the gross margin, Chetan, would be a little dynamic in our case, as I explained earlier too, because it will depend on the kind of MOCs that we handle. So, hi Chetan, can you hear me?
Yeah, now we are able to hear you. You are telling that the gross margin are dynamic, and then we got disconnected.
Yeah. So sorry, the call got disconnected. So what I was saying is that they will depend on the type of MOCs that we handle. As we handle more exotic, you will find the gross margins to be on the low because the material cost goes up. That's the main reason for that. And in terms of other expenses, as I said, we had one of the best executions in terms of EM Raffle heat exchangers in this quarter, which we have to pay royalty to Brahman and Role, Italy. And added to that, we had a lot of equipment delivered of Helix heat exchangers, which again we had to pay royalty to Lama Heat Transfer. But as I mentioned, these are costs already built into our estimation, and it will not impact our EBITDA any which way.
Right. So it will be fair to assume that whenever there is a higher gross margin, it will be getting offset because of the outgo on account of royalty and licensing fees?
No, it's not like that, Chetan. Incidentally, this time what happened was carbon material was leaner material, but at the same time it was with technology product, which is either Helix or M-Raffle. If it is a normal standard heat exchanger, then it will not get offset, because we will not have the royalty to be paid for normal heat exchangers.
So on a continual basis, other expenses, percent of sales, what it should be? Because ideally it was in the range of 17-18%, and this quarter it has gone up to close to 26%. So what should be the range for the other expenses as a percentage of sales?
So on an average, if you look at quarter to quarter, because it's going to be dynamic, you can assume 19 to 20% average other expenses.
Right. And other one on the interest cost also, though it is not sharp or it is not that material, but the quarterly interest cost has gone up to 2 crores, which was like 60-70 lakhs every quarter. Anything which is led to this?
That's mainly because of the working capital block. If you look at our working capital block, and as I explained, we had very long cycle items and largely FOB contracts, which are ODC. So it took about 30 days from my shop to the port. So that's where we needed some working capital, and that's why it's a short term and one-off.
Right. Okay. Thanks, Reggie.
Pleasure. Thank you.
Thank you very much. The next question is from the line of Jaiveer Shekhawat from Ambit Capital. Please go ahead.
Sure. Thanks for taking my question. Reddy, hi. Good evening. Reddy, first question, the inquiry pipeline that you have shown in the deck, about 850 odd crores. What would be the strike rate of that, and by when do we expect to finalize that?
Yeah, hi, David. So these are inquiry pipelines which should be finalized as per the normal timeline in the next 3 months. That's the window which normally takes for any firm inquiries in our hand. And the strike rate for these, because these are focused ones, their strike rate should be anywhere in the region of 30 to 35%.
Understood. So with that...
And it will be rolling. So 1100, if you see, even in the last call, we had close to about 1,000 crore inquiry. Some got finalized, the new ones came in. So this 1100 crore, considering the macro dynamics today in terms of how the market is moving, I believe for the next 6 to 7 months, the average inquiry pipeline should be in the range of 1100 to 1200 crore, which augurs well for us.
Understood. So on a quarterly basis, I think we can still expect about a 250-300 crore of an order intake. I mean, if your inquiry pipeline tends to be about 1,000-1,200 odd crores with that 20-25% strike rate, is that a fair understanding?
Yes, in fact, that's our strategy as well. The intent is that every quarter we should be getting in at least approximately about 200 to 250 crores fresh order intake.
Understood. With respect to your FY'27 growth targets, because I think we have talked about at least maintaining around a 20% growth on top of the 850 odd crores of revenue that you do. What kind of opening order book would you want to be starting the year with, and what order book would you be comfortable with?
So as a starting, as I mentioned earlier, as we step into the 1st of April of the year, we wish to have at least 75 to 80% of the revenue planned for that particular year. So if you look at from FY'27 perspective, we should be comfortable with anything between 700 to 750 crores.
Understood. And I think this quarter we have seen an increasing pickup in order intake, as you had also been highlighting in the previous call as well, across both domestic as well as exports as well. So in terms of your inquiry pipeline, is that more focused on the domestic at the moment, or are you seeing uptake in the exports market as well, especially Middle East and other regions?
No, it's of course 50-50. Good uptake in domestic from nowhere. If you look at previous 2 quarters, there was nothing. And international global has continued to getting good inquiries. Of course, especially driven by Middle East. So I would say 50-50% is the inquiry pipeline.
Understood. Thank you so much, and all the best.
Thank you. Pleasure talking to you.
Thank you very much. The next question is from the line of Gopalakrishnan Subramanian from Utkarsh Investments. Please go ahead.
Excellent afternoon, sir. Are you able to hear me?
Yes.
Yeah, great. Yeah. So my first question is, our company's sales growth for the past 3 years has been 36%, and whereas profit growth is only 23%. And even in the trailing 12-month period, it is not a very encouraging scenario. Why this profit growth is lagging behind the sales growth consistently? This is my first question. Can I go to the second question, or should I wait for the answer and then ask my second question, sir?
Hold on, we'll answer your first question.
Yeah.
So if you look at the tax as a percentage in corresponding period, then tax as a percentage was quite low because there were certain ESOPs. If you look at the result declared, then during corresponding period last year, the ESOP sales exercise were of 101,000. That is the reason there was a huge tax benefit which led to a lower tax, and that is not the case in current period. That's why if you see the revenue, EBITDA and the PAT, PBT has increased, whereas the PAT has not decreased in the same fashion.
Okay. Thank you, sir. So going forward, what you are saying is profit growth will overtake the sales growth. Can I take it like that?
It would be largely in line with the top line growth.
Okay. So, fine. And then my second question is regarding the order. See, in FY'25, we did around 730 crore turnover. So if you take 20% to that, it will be 880 crores is what we should be achieving in FY'26. In that, we have already done 408, which means our balance 472 is there. In that 472, we have an order of 569, which means as of today, even if we don't get any order till March, we will have a pending order of 200 crores as on 1st of April. And going forward in the next 6 months period, we should get enough orders to cater to FY'27. So as on 1st of April, we should have almost the entire year covered. Is my understanding correct? And in that, any American orders are likely, because if I'm sure some tariff clarity will come. So, but as of now, we don't have any dependence on America. But going forward in FY'27, what will be the extent of dependence of American orders?
Yeah. So, as mentioned earlier, as we step into any new financial year, we wish to have 75 to 80% of the revenue plan for that year. So, in that perspective, as I mentioned, anywhere between 700 to 750 crores as on 1st of April, pending order book, we should be comfortable with. Why 75 to 80%? Logic is because there are short-term shutdown requirements which customers want, which needs to be delivered within 6 to 8 months, and which are very profitable orders. And that's the reason we keep about 20 to 25% capacity for short-term delivery items. So that's the first answer. On the US, of course, as I mentioned in my previous call, for these numbers that we are talking about right now, we have discounted any opportunities in United States because we are waiting for a certainty for the tariff. But having said that, we are also in discussions with customers in United States for inquiries, which will be materializing in 2 to 3 months time frame. And I'm pretty sure we are all hopeful that some certainty on tariffs will evolve by then. So that should give us further fillip to the order book position before March.
Thank you, sir. One more slight clarification, sir. The 200 crore invoice was pending because there was no space with the customer. I mean, have you dispatched those 200 crore orders, sir?
So, of which we have already made close to about 80 crores. The balance were in the process. We have not dispatched those, but we have come to a very good negotiation with the customer. They are of course paying us for the storage charges, and also they have given a firm date to pick up in the month of February. So there are ships being booked and they will be delivered. And at the same time, they will be paying us 90% of the money even without dispatching the goods. So all in all, pretty good settlement and more certainty in terms of when the equipment will move out from here.
Okay, sir. And then one more thing, sir. I see you are saying that the short-term borrowings have gone up because there is not much of advance payment from the customer. Is it because we are dealing with two big customers and their standard terms are not giving any advance, and we had to pay the raw material supplier ahead of time to get the material and all of that? Is it because of dealing with two big customers?
So let me clarify. This lack of advances is not because customers are not paying us. It's only because our order book intake in the Q1 and the previous quarter was not that great, because of which the advances have dropped. Now with Q2 having improved, these advances will come as the milestones arrive in the month of November and December, and the advance book positions would go up. So it is not because customers are not paying, it's only because our order intake was not in line with our expectations.
Okay, sir. Thank you. Thank you. All the best, and hope to meet you with the next quarter call, sir. Thank you, sir.
Thank you. Thank you for your question.
Thank you very much. Participants who wish to ask a question may press star and 1 at this time. I repeat, participants who wish to ask a question may press star and 1 at this time. The next question is from the line of Darshil Jhaveri from Crown Capital. Please go ahead.
Hello. Good evening. Thank you so much for taking my question. Firstly, congratulations on a great set of results, sir. Hopefully, I'm audible.
Yes, please go ahead.
Yeah. Hi, sir. So, sir, a lot of my questions have already been answered, but just like one question that I had, that you're saying you want to, start the year with around 750 crores order book, which would be around 75-80% of the revenue plan. So, if I reverse calculate, that would mean that we want to, target 1,000 crore year for us. Is that a fair way to look at it?
Yes.
But with compared to the growth that we have been done in the past, that would not be substantial, right? We are planning 20% this year. 1,000 crore over 850 crores would be around 14-15%. So, is there like any upside that, you want to guide for in that way?
So if you look at when I say 1,000 crore, it will be little over 1,000 crore. So what we said is we had great 3 years in terms of our CAGR growth of 37% approximately, with a lot of investments done. Now we have completed with all our capex investments in terms of capacities, and now it's time for us to deliver results on those capex. So from a lower number, we moved very aggressively for the last 3 years, and now we need to stabilize our operations. And if you have heard our guidance, we were supposed to grow aggressively for the first 3 years and then normalize it in the range of 20-25% growth rate. Because beyond 1,000 crores, I am pretty sure you would understand that growing at 37% will be too tight for this kind of an industry. Having said that, this growth plan is only for organic growth plan. Anything that we are doing on the strategic acquisitions or anything else that comes our way inorganically, that would be upside of it. So that, as I mentioned, we will come back to you as and when developments do happen. But these growth plan is purely on our organic growth with the product portfolio and the customer base and the sector that we have today.
Okay, fair enough, sir. Like, so just wanted to clarify that 20% growth rate would do, right? Because if I would, do 1,000 crores over 880 crores, that would be roughly 13-14%. That was my area of concern.
1,000 crores plus, sorry. 1,000 crores
yeah.
plus.
Okay. That's really helpful, sir. And sir, just wanted to know, you clarified a bit about, the royalties, but from what I understand that the higher, higher gross margin products also carry a certain royalty. So even if it's a higher gross margin, eventually the EBITDA turns out to be same as our normal heat exchange. Is that the correct way to look at it? Or, you could just help us clarify how much royalty did we, pay in the current quarter, so, we could just help match those numbers.
Yeah, so the royalty percentage remains the same irrespective. So a percentage of the total value of the equipment. So it doesn't depend on what kind of metallurgies we work with. With more exotic material, the royalty for same tonnage equipment will be higher because the value of the equipment is higher. If it is simple metallurgies, the value will be lower. So it's a percentage of royalty is fixed. It's a little confidential right now in terms of, because we have a confidential agreement with the licensors, we'll not be able to disclose the actual percentage, but you can take it as is in the range of 5-10% for different licenses. So right now we have executed in Q2 for 2 licenses. One is M-Baffle technology and the other one is Lummus heat transfer for Helix heat exchangers. So it's a percentage on the value of equipment.
Oh, okay, fair enough. So, and just last question from my end, sir. With regards to the inorganic opportunity, when do we, see, are we in a process of, with maybe that we can have an acquisition in this year or next year? Could you just, help us brief a bit about that?
I will be cautious to put a timeline to it. There's a lot of discussions on. That is all that I can mention at this point in time. Because there are a lot of opportunities that we are looking at, as I mentioned in my opening remarks. especially into the new age energy sectors and specialty chemicals and packages. But sure, as we get closer, we will surely come back to you with more information.
Fair enough. Yeah, that's it from my side. So thank you so much. All the best.
Thank you.
Thank you very much. Ladies and gentlemen, before we take the next question, we would like to remind you all to press star and 1 to ask a question. The next question is from the line of Ranjit Kumar, an individual investor. Please go ahead. Mr. Ranjit Kumar, please go ahead.
Hi, Reggie. How are you? What percentage of sales was export to US last year before Donald Trump came into place?
Sorry, if I understood the question correct, what percentage of revenue did we export to US?
Yes.
Yeah, so last year it was overall all put together was close to about 30% of the total export.
So you are going to hit with tariffs. What's your forward take on this? Because that's going to affect your, because huge percentage of sales comes from US and tariff is going to affect you. How do you expect that in next quarter, next year?
Yeah, so let me get it.
And what are you doing to mitigation?
So 30% of our exports, so that's roughly about 15% of our revenue we exported last year. This year, if you look at, we have hardly anything that is exported to US directly because we didn't have any order book from there. We focus more on Middle East. Tariff, of course, as I mentioned in my call, last call as well, for us, whatever contracts that we take from our customers is straight on board FOB India port. So obviously it impacts us in terms of landed cost and the competitiveness when customer looks at it from US lens. But as I said, in all our projections that we made, we've right now discounted for the business from US. Anything that comes from US is going to be a bonus for us. Having said this, as mentioned, we are in talks with customers right now from the United States for many inquiries, despite having 50% tariff. And we are pretty sure, based on the conversations and I believe the way tariffs are, things are going to normalize in maybe maximum 3 months. But of course, as I said, that's going to be bonus for us. We have discounted business from US from our projections right now.
And when did you start your office in Houston?
We have not started. We have plans to start. We're just waiting for how things pan out, considering the current scenario, and we will take a call. So we thought it was right to start the office in Middle East, in Dubai, because that was a bigger priority for us at this moment. The next would be Houston.
Perfect. Thank you. What are the reasons this company is 6 decades old, 60 years old, and you're in oil and gas and petrochemicals, while Houston is probably $550 billion GDP that's combined Gujarat and Maharashtra together and consuming 19 million barrels a day. How do you explain that you had no presence in Texas and US for this long? And you're in oil and gas. Because for me, oil and gas, US is bigger than Saudi Arabia or UAE combined.
Yeah, so that was part of our strategy. How do we expand? We started off with many countries in Middle East. We had representations in Abu Dhabi, we had representations in Oman, Kuwait, and now official presence in Dubai. And the next stop is at Houston. So it's a strategic plan. I do understand and I take it that Houston is the biggest hub for oil and gas. But I think we've been doing pretty well in terms of connecting with customers, because as you know, 7 to 8 EPC contractors gives us 70 to 80% business for us. And the EPC contractor is the same who executes the project largely in US too. So from that perspective, we were pretty fortunate to get repeat orders from our EPC contractors. Why now we feel the need to be in United States and having a presence in Houston is to cater to the other customers who are local and who do not work with these large EPC contractors.
Thank you.
So in short, I would say it was part of a strategic game plan to spread at a defined pace.
Do you have presence in Canada?
We don't.
Okay. Thank you.
Thank you for your question.
Thank you very much. The next question is from the line of OP Gandhi from Siddhi. Please go ahead.
Yeah. Good afternoon. My first question is, what is the potential of U.S. market? And if U.S. tariff is removed, then will you revise the guidance from 20 to higher side? And my second question is about the competition from glass-lined heat exchanger.
So, in terms of glass-lined heat exchangers, let me answer that. We are not into glass-lined heat exchangers, so we do not compete with them. We are purely non-glass-lined at this moment. In terms of US can be...
And suppose if US tariff is shortly announced, then will you revise your guidance for next year?
So our guidance was largely from the perspective of our strategic roadmap of growth. Yes, with US providing more opportunities, we could look at a slightly higher percentage, but broadly our growth plan of 20% plus was guided by our strategic roadmap.
Okay. Thank you, sir.
Thank you. Pleasure.
Thank you very much. As there are no further questions, I would now like to hand the conference over to Mr. Reginaldo D'Souza for closing comments.
Thank you all for your interesting questions, and I hope I was able to clarify to your satisfaction. In case if you have any further queries, please feel free to connect with us and we would be happy to respond. I take this opportunity to thank my wonderful team at Anup and to each and every stakeholder helping us deliver performance. A big thank you to our shareholders for your trust and support as always. Thank you, take care and stay healthy. Thank you.
Thank you very much. On behalf of the Anup Engineering Limited, that concludes this conference. Thank you for joining us and you may now disconnect your lines. Thank you.